afternoon for the press conference of Bajaj Housing Finance Limited's IPO. This is an iconic moment for Bajaj Group. This is the first IPO in 31 years for them. And this is the most awaited IPO for the year in India as we speak. As you may be aware, the HFC, Bajaj Housing Finance, is the second largest HFC in India and the first largest or the largest non-deposit taking HFC in India. It has done phenomenally well. The asset quality, which is measured in terms of non-performing assets, is the lowest amongst all the large peers. It is very well diversified across different products, which includes housing loan, LAP, builder finance, etc. So very well diversified product portfolio. And the public issue will open on 9th September and close on 11th September. The anchor book will close on 6th September. We are thrilled to bring this opportunity to the market.
The issue will open for subscription on Monday, 9th of September, and it will close on Wednesday, 11th of September. The price band for the IPO has been set at Rs 66 to 70 per share. The total size of the issue is 6560 crores or 6,560 crores. Of this, 500 crores is available as a reservation for shareholders of the promoters, our promoter entities, and 200 crores for the employee base of the company. Other than that, the remaining part of the issue is divided into QIB 50%, HNI 15%, and retail 35%.
Bajaj Group, while Bajaj Group does not need introduction, it's a 90+ years of a heritage in the country from the Bajaj Group as a recognized retail brand. And within retail brand as well, there are very large spectrum of financial services what group offers under the umbrella of Bajaj finserv Limited, which is a CIC or a holding company, non-operative holding company for various financial services business. It's a listed company. The blue, the center, the dark blue denotes a listing. So that's a financial services company. It has various contours of business. Lending is represented by Bajaj Finance. Everyone probably knows Bajaj Finance very well in terms of it's one of the leading lending institutions in the country. Insurances are from the insurance companies to insurance companies, Bajaj Allianz Life and General. Apart from Bajaj Finance, as a subsidiary of Bajaj Finserv, no other company is listed. That's why Bajaj Finance is a largely known company. We, Bajaj Housing Finance, are today 100% subsidiary of Bajaj Finance, and post this issue will become less than 100% but still dominantly owned by Bajaj Finance as a company. This is where Bajaj Finserv entire ecosystem is there. Assurance, which has insurance companies, two insurance companies, and Bajaj Finserv Health, which offer various assurance products to Indian citizens at large. Wealth products, which is asset management company, which is a new company, newest company from the group, around 1 year old mutual fund, Bajaj Asset Management Company. Financial securities, which is a digital brokerage services. In lending, Bajaj Finance, and of course Bajaj Housing Finance. Within the lending space, Bajaj Housing Finance is predominantly focused on the secured portfolio. Our majority of our portfolio is secured. That's a key differential between the way the business what we do and what Bajaj Finance business is done is in terms of we pursue largely the secured business and are present in the mortgage space. This is what we have done over the last 7 years. We started operations in 17-18, so we are not very old company, we are close to 6 to 7 years old company. In that short span of operations, we have become largest non-deposit housing finance company. We are also second largest housing finance company, LIC Housing being the largest. Of course, HDFC Limited merger and other, otherwise it would have been the third largest. We are also 8th largest upper layer company as per definition of upper layer companies by Reserve Bank of India. We believe we are the most diversified housing finance company which offers full suite of mortgage lending product. Our domestic credit rating, because our raw material is money and the ability to raise money at a cheaper rate, highest possible domestic credit rating, which is AAA by two leading credit rating agencies. And among all large housing finance companies, our GNPAs and NPA ratios are lowest. We are also second most profit making company, housing finance company, and with very strong return ratios. And we believe we are an experienced management team who run this company. Moving on, this is what is last 5 years journey, FY22 to FY24. Bajaj Housing has grown at the rate of 29.3% CAGR in last 5 years. Compared to other various peers in housing finance space who have been there, clearly we have grown the fastest amongst all the housing finance companies. This is full suite of mortgage product. Mortgage has largely 4 products, which is home loan, which is the largest product, followed by loan against property, lease rental discounting, developer finance. Others are a small set of niche products what we offer to our own customers to meet their other requirements. So largely 4 products, and others is a small part of the balance sheet which is offered to our own customers only. Going to the market opportunity, we all know India's story, we all know India growth story, the way it has been playing. Retail credit has been growing in country and projected to grow at a 13-14% at a systemic credit level total. And within systemic credit, housing, because we are the largest country by population now, and mortgage to GDP ratio remains low compared to other emerging economies as well, we say the developed economies. Urbanization, nuclearization of more households, favorable government initiatives, and a rising income level, I think all point out to continuing good success story for housing, and accordingly we can say for home loans, because home loans enable housing in that way. Within total overall credit, when you look at a home loans, which is our largest part of the mortgage business, it has grown at a CAGR of 12.6% in last 4 years, and by various estimates expected to continue to grow 13 to 15% CAGR in next 4 years. It is the largest industry or the largest asset class. Loan against property has had a very high growth rate in last 3-4 years, grown at the rate of a 16.5%, expected to grow at a 13 to 15% CAGR from here onward by various estimates. Commercial real estate, again, having a very good run 3 years. After post-COVID, the consumption of last 3 years had been great, and it is expected to continue to do well, backed by GCCs coming in the country and backed by IT and BFSI sector booming in the country. Moving to our strengths, we called out when we were presenting that slide on terms of what we have achieved. We believe that we have the most diversified mortgage lending product suite, and that's what is depicted in this chart. As a mortgage company, as a housing finance company, our majority of the assets have to be home loans, because that's what regulatory requirement is. More than 50% of the assets have to be home loan. But other than home loan, if you look at the other product categories, we are one of the most balanced or most optimized diversified mortgage product lending suite to enable us to deliver a mix of risk-return ratios, so that we can try and deliver an optimal kind of a return while not taking too much of a risk. Compared to the peers, I think we are much more widely spread, or our product distribution is much more widely done in a diversified manner. That is what this is depicting. These are what we call traits to strive to win in the mortgage space, because mortgage is a very competitive industry. What do we do, or what do we have which enables us to win in this space? We have a comprehensive mortgage product suite, I called out already. And within the mortgage product suite, we support all sub-segments of the market. It's not only the segments, within the segments also, sub-segments are catered to by us. We have a growth story which is supported by omnichannel sourcing strategy, and I'll come to that panel separately. A strong risk management framework, which is demonstrated by our good asset quality and low credit costs. We have access to diversified and cost-effective borrowing sources thanks to our name, which is a brand image, and also the highest possible rating, which enables us to access funds at cheaper rates. We pursue ease of doing business for customers as well as employees, because that comes as a DNA to us in terms of trying to look for an automation or a digitalization of the processes wherever possible to give ease of process to the customers and our internal stakeholders who are employees. Our financial performance has been consistent, return ratios have been good, and a quality board of directors, ably supported by the experienced management team, are our traits on which we believe that we have a strength to win. Coming on to the product constructs, which are 4 products, which I called out the 4 largest product. Home loan, which is the largest asset class within our asset mix, 53,000 crore of a balance sheet, roughly as of 31st March. Average ticket size of 46 lakh, largely dominated by salaried and a Euro 750 plus. Now that's a dominated there. However, we are present across all segments. We offer to self-employed. The point of a time, the domination of or the dominance of a particular segment can be more, but there is all kinds of a transaction and all segments which are addressed by the company. Loan against property, close to 9,500 crore of a balance sheet, 58 lakhs of a ticket size, average ticket size of 58 lakh, and a reflection of a risk in terms of a 71% of the assets being self-owned residential properties. Moving on the lease rental discounting, 7,500 crore of a balance sheet, operating in 14 locations, but by virtue of the nature of the business, it is largely dominated in top 6 or top 7. Average ticket size of 100 odd crore, which is the chunkier exposures. These are large customers who require larger amount. We operate again in all spaces: office space, warehousing, logistics, and industrial, but largely dominated by office grade A commercial property. In terms of a developer finance or a construction finance, 9,500 crore of a balance sheet. Granular balance sheet represented by 616 active project. Average sanction amount is 44 crore. However, average outstanding per account is close to 16 crore to 616 project representing 9,500 crore kind of a balance sheet. We do develop construction finance for first is the funnel for our home loan business because it enables us to be available at that counter to do home loan, and then of course it also helps us to generate returns. This is what I was calling about omni-channel sourcing strategy. Mix in a home loan balance sheet, 56% mix of a direct and a 44% mix of an indirect. In direct, we also include the customer that we source to the developer sites, whether because of a construction finance or because even if we are not continuing the construction finance, but we have done an APF of the project, our teams are present there. That is one of the largest funnel there. Digital ecosystem, because we use digital search engine optimization, we call it, or Google Analytics, we call it, to generate the customer leads to us, and our direct teams go and then close those leads. Self-sourcing, which is our DST team, and in indirect, all partners, whether from the smallest partner to the largest distribution partners, we try to work with all of them to expand our business funnel. Loan against property, a mix of a balance mix of 50-50, 50% balance sheet which is a direct and 50% which is an indirect. In terms of our commercial businesses, which is both lease rental discounting and developer finance, they are largely relationship led. Very little part of our lease rental discounting business comes through the channel relationship, but largely both the businesses are, since higher ticket size, they all largely come through relationship teams, direct sourcing. This is what we call our strong risk management. Now we are breaking the total risk outcome into two slides. First is retail, because one is a total company overall GNP and NP numbers. What we called out are lowest amongst all large housing finance company. But when we look at each asset separately as well, that is what is the outcome. In a home loan or retail businesses, we largely run through 6 centralized underwriting hubs. We don't run at a branch level, we run at a central, the back office, mid office from a controllership point of view, and also process efficiency and a cost efficiency point of view are largely run through a centralized hubs. We have specific underwriting frameworks for each of the business, whether a salaried and a self-employed, there are separate frameworks. Rural or urban businesses, there are a separate kind of framework. Type of a customer, affordable, non-affordable, have a different kinds of a framework. Along with that, we have strong centralized real-time monitoring or real-time control on the business processes, and so that before disbursal, if there are any controllership lapses, they are controlled. For collateral assessment, we have 8 hubs, centralized hubs, again because legal and technical evaluations become very important for the business what we are in. Top with that, there is a strong risk management framework, monitoring emerging risks or any through-the-door risks which are coming in through the dedicated risk management function. For debt management, it's largely in-house because we are a smaller company and our number of customers are smaller, and in that context, because of our high ticket size, we run largely through our in-house team. Outcome, even if you look at our home loan separately, not as a company there, our GNPs as of 31st March 24 are 27 bps and an NPS of 10 bps, which are far lower than any comparable player. In loan against property, we have GNPs at 68 bps and net NPS of 26 bps, again lower than the industry benchmarks or industry numbers which are depicted up to FY23 year, because they are a part of our DRHP, and after that industry numbers had not come when we had filed our DRHP with Sept. But the differential still remains because our numbers have been lower and industry numbers remains high. In lease rental discounting and developer finance, they are largely or they are done by central specialist teams which are present both in the field, but approvals happen largely in head office because of the ticket sizes. But the presence on the ground and the specialist teams is what is unique to part, because both businesses have a very different type of a need to underwrite. In lease rental discounting, you focus on three main factors: who is the lessor, that person who is borrowing from you; who is the lessee, stability of the lessee, and the type of a collateral and the location of the collateral, so that in case of a vacancy as well with the again the property be leasable. In type of a developer finance, largely factors are the type of a developer, his track record, his or her track record in the field there, in the presence in the market, micro market, how the person has been faring, and the type of the project and the project location, how the project is going to, whether the project is going to sell or not sell. This is the where the project is going to be located. So there are different types of nuances which is catered by the specialist team, again backed by a very strong risk management team, which is a centralized team which monitors the project status on a monthly basis, on a timely basis, to know again red flag if there are any emerging issues coming in. And being a relationship-led business, the debt management is entirely relationship. There is no separate debt management team for these business. Outcome in lease rental discounting business, we never had any NPA till date. In construction finance, our GNPAs have been 15 bps as of 31st March, and net NPAs of 4 bps, which are the outcome what we have delivered so far. This is the overall slide clubbing all the 4 businesses. As of 31st March 24, our GNPAs were 0.27, 0.3 is the rounding of number, and an NPA at 0.1, 64% kind of a provision coverage ratio, which again is one of our stronger points compared to industry and compared to the peers, both from a GNP and NNP performance as well as the provisioning coverage ratios. Moving on. Now our essential raw material for us is money, which is what I called out again in the slide what we presented as saying that we have the highest domestic credit rating now, and that enables us to borrow from a varied sources, not heavily dependent on one sources. So that's our borrowing mix. 51% of our borrowing comes to the banks, 35% comes to the money market in forms of bonds, 4% in terms of the CPs, and 10% comes as a refinance from National Housing Bank. We continue to endeavor to keep on diversifying, keep on deepening our relationship whether with the banks, and keep on raising more money through the money markets and onboarding more investors, so that we keep on leveraging and keep on optimizing our costs as far as borrowing costs are concerned. In terms of our ALM, we run liquidity buffers which are more conservative than what is regulatory required, which are liquidity coverage ratios are always we run higher ratios than what are regulatory required, so that we don't carry any liquidity risk inadvertently as well in the balance sheet. These are what we called as our digital initiatives, or our effort to automate or digitalize or give ease of process to whether our internal stakeholders or to the customers whom we deal with, whether acquiring at the time of an acquisition through a DIY journey, which is a do-it-yourself journey, up to in principle sanction letter, the customer can do it himself, or a customer onboarding journey, which if our person has reached out, that how the customer can come on board in a seamless manner. All our teams are again on mobility apps, because we run 100% cloud-based IT architecture, which enables us to be as dispersed as possible in the field and as consolidated as possible in the mid office and the back office from a process efficiency and a cost efficiency point of view. So it enables us, IT structure enables us to be friendly to our people, and which helps them again to bring customers on board in an easier manner rather than their processing, ease of processing or a digitalization of processes at the time of onboarding of a customer, whether it's a sanction letter, acceptances or sanction letters or agreements or any alerts in terms of in operation, anything going wrong or anything which is not in line with what we had expected it to be. Taking into the customer service, because mortgage is a long-term loan and a long-term commitment by a customer, most of the requirements what a customer has for servicing once the person has taken a loan is we enable it to be done through, again, do it yourself through whether the portal which a customer can use sitting at the comfort of his or her home to draw to service a need, or the customer service app again, which enables most of the requirements in the lifetime or in the life cycle of a mortgage customer which a person may require. These are what we meant by our consistent financial performance. Last 3 years numbers, 31% AUM CAGR growth, 56% profit CAGR growth, stable return ratios, 2.3, 2.4% ROAs of last 2 years, 14 and 15% kind of a return on equity, and with cost to income ratios going rightfully towards downward, because that's what is a measure of an efficiency or a operating efficiency.